G'day guys, and welcome to the third episode of the Pumped On Property Show. Now in today's episode, Ads and I are going to look at how to purchase your first investment property. So we're going to talk about the fun stuff, which is the research side of things. We're also going to show you how to create a 12-month plan as well as a 15-year plan for yourself or for your family. We're going to talk about your property investment goals and how to create the right strategy, and then how to use that strategy to go out there and identify the right market, the right suburb. And then we're going to get into the technical stuff, which is really about sitting down, identifying how to build the relationships with the agent, how to submit the offer, what to do after that offer has been submitted. So hopefully by the end of this you'll have complete confidence to go out there and get started on your first investment property. Well, that's our aim anyway.
Yeah, and I think we should be able to get there pretty easily. Like, we've come up with a little bit of a plan to run through with you guys today, and I hope that you can enjoy it and tune in for the whole thing.
Talk research, dude, because this is something that you and I are both passionate about.
Yeah, definitely. So I guess we've kind of split research up into a couple of stages of where you do it. Now, the first one is the fun research. Now, we call it fun because it might not necessarily feel fun, but you're not really getting anything done. Like, you're more so getting your ideas out there, trying to find some people that might agree with your sort of ideas that you already have at the moment, or even just, you know, dreaming out there, like the big picture stuff. Like, I imagine I want to have the mansion on the beach in 2 years' time, or that sort of stuff that, although might be achievable in a longer time frame, just might not be quite as practical as what you're hoping it is.
What's an example of that for you, bro? Like, in terms of the fun side of the research, what really got you thinking about as a first-time investor? What was that spark? Like, what was that fun side of the property research that you did?
I know, like, obviously coming from an engineering background where I first started, I am very numbers orientated, and I did do finance before this, so I think it was the financial side of things that honestly did motivate me at first, and just seeing what was possible with property, which you don't really have those same that same, I guess, potential with a lot of other investment opportunities in Australia.
From doing mortgage broking for a couple of years and seeing, hey, this guy bought a property 15 years ago for 500k in Sydney and now it's worth $1 million. I need to get onto this property thing as well.
Oh, 100%. When I was doing the financing, you'd just see, like, there'd be people that, just completely normal people, that just have happened to hold on to property, 1, 2, 3 properties for a large amount of time without stuffing around, without making unnecessary, I guess, moves and choices, and always chasing that next little dream in the immediate horizon. What they've managed to do over the long term is just create like a portfolio or a bunch of equity behind them that's very impressive, and it's definitely something that I want to focus for in my future.
It's funny, like, I've got this little thing in front of me now from Charlie Munger on my screensaver on my computer, and it's, the money is not made in the buying and the selling, it is made in the waiting. And it's like a crazy, it's made in the patience, like it's made in the waiting. And I think that's a good lesson for me, who rushed around and bought and sold a lot of stuff where I probably would have been significantly better off from just buying 2 or 3 really high quality properties and just keeping them. So you learn your lessons, everyone cuts their teeth.
Yeah, and obviously there's opportunity costs, which I think was always playing at your back of your mind there, that the grass is always greener on the other side.
Yeah, you know, sometimes the more you know, the more challenging it can be, but also the more fun it can be, because your results get better and better too.
Yeah, of course.
So, you know, the fun side of the research thing for me is I love listening to podcasts, I love watching videos. I also love reading, and so a couple of the books that I've picked up that have had a huge impact on me, and as a first-time investor would have, I think, a huge impact on most people, is really Rich Dad Poor Dad, which, you know, sounding like a dead horse there and flogging it. Everyone's flogging Rich Dad Poor Dad, but it is a really good foundational book. I also got a bit, and I know you've just finished it too, out of Mastering the Australian Housing Market, John Lindeman's book.
Yeah, I thought that was a fantastic, just good basic overview of the whole market in Australia. Didn't go in overly into too much depth in certain areas, but definitely gave you an excellent broad overview of the whole topic, which I quite enjoyed.
I like the first third of the book where he talked about the history.
Yeah, 100%.
I got completely over it after that, to be honest with you. But I finished it because it's the type of book you can read. I read it flying down to Sydney and back. Like, it's a 3-4 hour read. It's not a big one.
Yeah, it doesn't take long, that one.
It's a small book. I also, for people that are really interested in the detail, like me and Adsy are, I got a lot out of Phil Anderson's book, The Secret Life of Real Estate and Banking as well. Warning, it took me 9 months to read that book. First time around, it was just so freaking heavy.
Yeah, it's definitely a thick book, to be completely honest. I got like halfway through it and then stopped for about 6 months and then had to jump back into it and read it again.
If I was reading it again, I'd go straight to page 350 or wherever he talks about how it all comes together, because what he does is look at 250 years of booms and busts in America, and Australia's followed that cycle pretty clearly over the last 200 years. And just, you know, just jump to that, get the context, and then if you're interested in history and numbers and data, then go through chapter by chapter. But it is hard, like it's like chewing on some well-cooked meat, that one, for sure.
I don't know if it hurts that much, but you can't rush through it, that's for sure. It's like your brain's gonna get full after one sitting.
Yeah, without a doubt. So sliding from the research side of things, which I think is a really fun part, but as Adzi said, it's kind of, you know, you're sitting there just burning on the spot. You're not actually moving forward, although it feels like it is. I've got friends of mine that have been researching for the last 13 years while I've been buying.
Yeah.
Or the last 10 years, and they've sort of stayed in one position where obviously taking action is what this is all about as well.
What did they have to say about you and your journey as they go through? Do they always have these little sort of, oh, why didn't you do this? Or what, I've read that this is what you should have done. Did you get much of that?
Everyone's got an opinion, bro. Like, yeah. And we all hear it. I copped it off my family who weren't investors. Most of the boys that I grew up with still aren't investors in property. Some of them are in crypto, some of them are in shares, some of them are in business. A few of them are now getting into property. For the first couple of properties I bought, it was kind of like, what are you doing? After that, it was kind of like, F you. And now it's kind of like, oh shit, I wish I got started 10 years ago because your life looks pretty good.
Can you help me get a property, please, Ben?
Yeah, so, you know, that's the fun side of it all.
So jumping from there, I guess, where do you go next? Like, you've done a bunch of research, you've got all these ideas up in the sky that all sound great, and like you said, like, you've got friends that just research forever. How do you take that next step? Like, how do you turn that research or those ideas into actually those next steps forward? You know, if people are listening to this podcast or watching this vid, they're probably watching a few others, and what my favourite thing about properties is because of the quality of the content online now, you can be the kid in the candy store. So you can go listen to the Property Couch dudes who we love, and you can, you know, think about what they do, you can think about what we do, you can think about some of the other ideas that people have, and then you can sort of write a pros and cons list of different ideas people have maybe, and you can, you know, pick and choose what sits best with you. Now, certain people like different people for different reasons. Taking the personalities aside, we're trying to find a strategy that works for you, and that's where it really feeds into, where do you want to be long term? You know, what do you actually want your life to look like, and then, you know, what does the next 12 months look like to link to that 15-year plan? Yeah, that makes sense, and I really like that idea of reverse engineering it backwards, because obviously it can be quite hard when you are going through and you're hearing all these ideas. So say we've been listening to the Property Couch, you've watched some of our videos, you like the idea of this strategy, you like the idea of that strategy, or what they're saying here, but when you try and put all those things together without an actual clear own strategy, making sure those all meld together and are going to work together, it's quite easy to get lost from there, do you think? 100%, it's so easy to get lost, and it's overwhelming too, because there are so many different ideas here that it can be really challenging to go, this is what I'm going to do. Yeah. Just getting started. So there's two things I think that can really help with that long-term planning, because you can't plan out every day for the next 15 years. Like, I can guarantee life's going to get in the way and stuff's going to happen that you don't expect. Yeah. But definitely. What you can do is go, 15 years from now, my ideal week or year would look something like this. And for me, and I think you too, because we chat about this, it's just about choices. Yeah. You know, in 15 years, if I want to start a business, I can. If I want to quit my job, I can. If I want to spend my life with my kids, I can. If I want to travel, volunteer, train more, you know, whatever that thing is for you, they're all choices, and having passive income for life enables you to have more choices. Yeah. So one is choices. The second is whatever your current annual salary is now,
you know, I think you should aim to replace it over 15 to 20 years.
Yeah, so this is basically your strategy, and where you think that if you don't have an end goal, or if you don't have a point in the future where you don't know where you want to be, this is a great place to start, and then you can kind of work from there. Let's aim to replace your wage, replace your income, and then let's work back. Let's see if we can make more happen. Let's have that choice, that flexibility afterwards. For
sure, because the thing about replacing a 50 grand a year wage is, once you've figured out how to do that, it's equally easy to make 100k a year. You know what I mean? Once you've got the skill set, it's like a snowball running down a hill. It picks up momentum.
And obviously, if you do replace your 9-to-5 job, that's an extra 40 hours you have in a week to try and replicate that process, which you may have done in 10 hours a week the first time round. Is that
for sure? You know what I mean? 100%, because you know, as you earn more, you learn more as well, and you become exponentially more valuable to people around you in the market as well. So. I think, you know, those two things, you know, if you don't have a line in the sand, which from speaking with 6,000 investors and looking at myself in a mirror right now, you know, it's the hardest thing as a first timer to figure out, you know, where you want to be.
Yeah.
So choices, whatever you love about your life, magnify it in the future, because you've got 40 hours a week that you don't have right now, or you might have young children right now. And, you know, like I do, I've got 3 kids under 6 years of age. It kind of feels like a lot.
Yeah.
But 15 years from now, they'll, you know, all be in high school or out of school, and life will look a lot different as well.
Yeah, of course. And I guess you just can, like, for people our age, we can look at our parents and just see how those sort of things can change, and imagine how different things could be in the future. And I know from some of my own parents and my own family, just looking at the differences of how people can end up with different sort of mentalities and different ideas on how they're going to use their time. More so, I was going to say money, but I think it's more so how they want to spend their time in certain stages of their life and what it can create for their future.
Yeah, like, I mean, both of my parents are still working now. I think my dad really does enjoy his business that he operates.
Yep.
Where my mum, she does enjoy it, but I think it's more a financial decision to come to work every day. So, you know, I've seen them both go through that journey. Mum's 55, dad's 63, and I just want choices at that stage of my life personally, and so that means doing something now.
Yeah. And that's fair. Like, I feel like I want choices right now. Unfortunately, it can't happen right now, but like, if I come up with a plan, it should be able to happen in, say, 5, 10 years, 15 years time in the future. So it's exciting stuff.
Do you know what the coolest thing about having a plan for me is I can see where I will be if I execute it, and it gives me a reason for getting out of bed on those hard days. Like, everyone has good days and bad days, of course, but it gives you a very strong why. If you're going to a job you don't like at the moment, like you and I have done before, and I hated it.
I'm a little bit sick at the moment, if you guys can't tell, and I wouldn't be here if it wasn't this job.
Yeah, you should be home, man. But yeah, the door's shut as well. I just feel like I'm just talking this right now. Hey, somebody open a door. You know, but I don't know where we're going there. I've just lost my track.
I lost too, sorry.
So long term, it's pretty simple. Think about where you want to be, what choices you want, and your financial freedom at that point based on your current salary. And then your 12-month goal, if you haven't bought a property, should be, you know, if property is part of that financial strategy, pick up your first property. And that might be really easy for some of you. You might be ready to do that right now. For others, it might be completely overwhelming to think about it in the next 12 months, and you need to, you know, save some more money or feel more comfortable about whatever it is that you're trying to learn. Just from someone who has spoken to over 600 investors going through this journey, what do you find are the typical sort of roadblocks that do happen that stop them from, say, achieving that first property in 12 months? Yeah, so the number one thing that stops people is fear. Okay, yeah. And fear is a whole lot of reasons or excuses underneath that. So it could be information overload. It could be I don't have a clear strategy in place right now, which is really challenging. It could be I don't physically have a budget or savings in the bank or equity in my home to be able to do something. It could be I've got ripped off by somebody before and I'm afraid of doing it. It could be I don't have a partner that's supportive of this. Like, I'm really into property, but my wife Lisa, she likes renovating it and building it, but in terms of the detail of which market, what suburb, what we're going to buy, she's just not interested in any way. So it was really hard at the start to sort of pull her kicking and screaming through it and going, let's not buy the second car, or let's not, you know, up our lifestyle right now.
Yeah.
Because 10 years from now I can see where we'll be, but she couldn't.
Yeah.
And now it's 10 years on, she's starting to get it.
I don't think it's a get it or not get it thing. I think it's more so when you spend as much time as we do thinking about this sort of stuff, it's easy to see that end point because we think about it all the time. Whereas if you're not investing your time thinking about this stuff, it's a lot easier to go, what are you talking about? Like, what if it doesn't work? What if this doesn't happen? So
it's such a good point.
Yeah, like I don't think it's so much that whether or not she was into it as much as you, it was more so you just thought about it a lot more and was really attached to that idea of where it was going to end up.
Yeah.
She might not quite have been there, but you did mention a range of different things that might slow people down. So obviously they all need to take different paths to get to that point of being able to move forward. What would you usually recommend in those situations? Just taking that first step or coming up with a plan? Is that the best way to do it?
I think the best thing, like in terms of getting around the challenges or the what's holding us back question that we all have, and as someone that's bought quite a bit of property, you've bought property and you've helped people buy it too, those fears and those challenges never go away. Like I still don't feel comfortable when I buy ever, because I'm putting an extra 400 grand or $1 million debt against my personal name, and it doesn't feel comfortable going into debt.
I feel like you're putting a trust in a lot of parties and different parties. So say like it could be the person you're purchasing the property off, you're also putting trust in a real estate agent, you're putting trust in your solicitors. There's so many different people involved in the process that it can be quite easy to feel scared and to feel like there's too many unknowns and you're expecting people to do the best by you and you're just not sure if they're going to actually do that or not. 100%.
Like there's all of that stuff, and just I think acknowledging and accepting that it is going to be a bit uncomfortable, that you know, I do have things, and we all have things as investors that hold us up or catch us out sometimes that we have to keep in check, and we have biases, but having a clear plan in place, having a great team in place of people that you can bounce ideas off, you know, and educating yourself are the 3 ways that I've been able to personally overcome those fears. So
awesome.
My mortgage broker, who you know very well because you used to be mentored by him basically, owns 25 plus properties outright himself.
And a great guy.
Legend of a dude. You know, my solicitor owns all of his properties outright and has great businesses. So does my accountant. So there's this team of people around me, plus friends that are in this space, plus clients that you connect with that become mates, that just, you know, give you that confidence, that share different ideas, and over time that becomes a bigger tool belt, and you know, things that were very overwhelming in the past become really, really easy, and instead of feeling like you're jumping off a cliff, you're stepping off a little gutter. Yeah,
of course. And so like I guess there's a lot of emphasis there on having those right people around you, and it's like I was saying, there's a bit of fear about can you trust them or not. How do you think is the best way to find someone you can trust? Obviously you've built up a bunch of referral people that you work with at the moment that you've had to kind of gone through the ringers with perhaps ones previously, but for other people, what would you recommend? Like obviously we're happy to share the people that we've met along our journeys.
For sure.
If they're not connected to us, what would you recommend? Say doing the same thing, asking their friends, trying to build that community first?
Yeah, I think starting with, everybody's got someone in their life that probably owns 1 or 2 properties, maybe even more. You know, it might be an extended friend, it might be a colleague at work, it might be a brother or a sister, but they have someone that's probably a little bit further forward than they are. Even 1 property more forward can be huge. So it's simply, you know, going and talking to those people around you about, you know, how was that solicitor to work with? You know, how was that mortgage broker? How is that property manager? And just getting a feel for it. You know, I've had 7 or 8 different mortgage brokers, like 6 solicitors, 11 different property managers. You kind of get a sense over time of who is going to be good and who's not. But the one question I ask all of them is, what are you personally doing right now? And where are you at on your journey towards financial freedom? Because I believe the quality of my life is determined by the quality of the relationships. And if I've got an incredible team of advisors who are significantly further than I ever want to be, then I can, you know, tuck under their wing, learn from their successes, and just follow what they've done until it doesn't work. And right now it's working for all of them. So, you know, why reinvent a wheel? You know what I mean?
Yeah, definitely, of course. And we're all looking for mentors, we're all looking for help, and you get this idea that you need to have someone that's just going to like come in and save the day for you sort of thing, but you've got people around you that you can lean on and that you can ask questions that can always do that. And like Ben said, it doesn't have to be the expert in that field. Like, that can definitely help and make it a little bit easier, but if you don't have access to that, there is just that friend that is maybe that one step ahead who can help you along that journey.
Look, when I bought my first property, I got a referral from a friend for the solicitor. I jumped on Google and interviewed 3 property managers. You know what I mean? Like, they weren't the best. I just walked into my local bank, and as my bank manager, like, these people weren't the best in the industry, but it was enough to get me into my first deal. And then it was probably by the second deal that I realised, hang on, there's probably better quality advisors out there, and I started to go up a level and then up a level, and you just, that's the journey, you know. Start where you are. Don't stress out too hard on it. Like everything in life, it tends to compound over time, so like you naturally just grow and grow, and as you do that, the people around you change and grow as well. 100%. Awesome. So I guess we've talked a little bit about setting a strategy, some challenges that can happen when trying to determine that strategy, or maybe not so much a strategy, but just more so your own goals and things. So to turn it from those goals into an actual set strategy, we mentioned, so reverse engineering it backwards, is that the best approach to doing it, and is that the approach that you stick by? Yeah, I think that's the best approach. And you know, your long-term goals should drive what you buy. Your strategy should drive which market, what type of property, and how much you spend. So the clearer you are on where you want to be in the future and your strategy around a property, the simpler it is to actually go buy something, because when you've got a clear strategy, 99% of stuff in the market doesn't qualify. And so it makes looking on realestate.com or talking to agents super easy. True. So instead of saying, oh, we're looking for a house that's great for an investment, and relying on the real estate agent to try and put you in the right way, would you recommend going out and doing some real technical research about what you want to find and what that right property looks like and what is going to be a good performing asset over the long term? I would go back a level. Like, when we talk about technical research, there's a few things here, and maybe we can just use you as a dummy here, like, you know what I mean? Like, let's just pretend that this is your, well, let's just be truthful, this is your situation. So technically, there's 4 things that I believe are rules in property. If you follow, it's very difficult to long-term stuff it up. The first is timing the market. Awesome. So is that on, like, by the market, are you talking Australian market, or are we talking, like you mentioned, as what, like a global market, US markets? Where are we with that? I like to follow Phil Anderson and Fred Harrison's work on timing, because they're the only 2 guys that I'm aware of that have successfully predicted the last 2 booms and busts in a big way, like the GFC and then the recession we had to have before that. So I like to find people that have called it, not during it going, hey, we're in a bust market or we're in a boom market, which everyone can do, but people that call, hey, it's really good times now, but 5 years from now it's going to look bad. And so Fred Harrison and Phil are great people to look at the global cycle for timing. And we are such a global world now, with our stock markets, our commodities following each other, you know, money following itself around the world. That we're all interconnected in some sort of way now. Like, almost everything is in some way. But yeah, the International Monetary Fund came out recently and talked about that, just how connected Sydney and Melbourne in particular are to the global cycle now of New York, Singapore, you know, Hong Kong, the big markets. So basically just those big global cities around the world. Yeah, because they're all connected to the same stock market, and you know, that has an effect on stuff, as does all sorts of things which we won't go into today. But you know, the first is timing, the second is buying houses. So with timing, you mentioned the global market. Is that your timing? Do you line that globally? Do you also break it down into a smaller sort of market? So like, do you try and time it on like a state-by-state basis or a city-by-city basis? Really good point, actually, because I use the overarching timing, which, you know, there's this 18-year cycle that's been working pretty much in America and Europe now for over 250 years. This blew my mind when I first read about this and did a little bit of research in it. We continue. It's just crazy, and I've done videos on it, and you can read Phil Anderson's book and just understand it, or watch one of his 10-minute YouTube clips and you'll be blown away. But you know, there's this big 18-year cycle where, you know, property prices go up, they sit flat or go down a little bit, then they go up again, and then they come down. And it just has repeated itself very, very consistently. The only time it didn't repeat itself was in World War II, in 250 years. So, you know, that's the big picture, and you can learn about that. And then at a local level, there's really only two people in Australia that consistently get it right. One's CoreLogic, and they do a really cool update video format that you can watch an update on the entire Australian market once a month for 10 minutes, and you'll get more than you'll get out of watching the news every single day for that month. And then there's Heron Todd White, who produce a month-by-month update or clock on where each of Australia's capital cities are at. So I use those two to just understand the local thing, and then I overlay the bigger picture in terms of when to buy, when to sell, when to hold.
And so the trust is with Heron Todd White and CoreLogic, basically because they do a lot of actually data analysis, and they control a lot of the data and research heavy, rather than I guess more so just chasing whatever the most common media story or whatever's going to get the most attention at the time is.
Yeah, like these guys are just analytical people run by good business, like smart people at the top that are very analytical, and it's just data orientated. There's no agenda. They're not trying to sell anything as a result of the information they produce. They're just collecting data and using that data to interpret. So there's no of course there's bias in everything, but there's no
because there's always a human aspect to it, which you can't take out of those sort of things. But it's still at the same time, when you're backing it with data rather than secondhand information that's, you know, I'm referring to someone in this article who referred to someone who wrote something a week before that, and it kind of just chains on. Like, I'd much prefer to go to the source and to go to those people that are actually analysing the data.
100%.
So sorry, I kept jumping back into that timing because I just felt like it was a great one to kind of go through at the moment. Yeah,
and I think in a future episode we'll talk about that 18-year cycle, the 7-year cycle, and timing, and really getting that right, because it's a deep topic that's taken me 10 years to get my head around properly.
And like you said, it did come out of that book, which is a lot to take in at the time. So we don't want to kind of just throw all that down your throat straight away. So that's the first out of the 4. What was the other 3? Sorry, did we kind of touch on them a little bit already?
Look, I'll just touch on those really quickly. If you buy Australia's capital cities, we know that history, according to CoreLogic and the Australian Bureau of Stats, says that prices in Sydney, Melbourne and Brisbane outperform everywhere else over time. So again, if you stay connected to the biggest cities where the population is going to be on the east coast of Australia, or the major markets around them, Sunshine Coast, Gold Coast, you know, Newcastle, Wollongong. I'm still not sold on Bendigo and Ballarat. But Melbourne,
not quite there.
I just don't think they're there yet. You know, they're what has historically performed well. So that's another rule. And then if you buy houses, strictly houses in those markets, according to CoreLogic, houses have outperformed units by between 1% and 3% every year.
Cool. So we're not really delving into the why at the moment. We're just, these are the stats, these are the figures of how it's performed previously. We can't see into the future, but if this is what's previously been the high performing assets in Australia, I know that's what I want to be buying. But continue. Sorry, what was the 4th?
So history should determine where you buy, just because you know, you can walk into a casino and pretend you're going to break the bank, you know, beat the odds, but the reality is, like, from personal experience, you know it. And that's the property market. Like, everybody is constantly trying to, you know, and sorry, to link this all back, if you understand these things and lay that into your strategy for your next purchase, you're going to be exponentially better off in 15 years time than if you don't. And so we'll talk about specific property investment goals in a moment, but these are the 4 rules that if you follow them, even if you really fuck stuff up one of them, I don't want to swear on this, but you know, that's how much I think it needs to be said. Even if you really miss something and do these things, you're going to end up all right. And the last thing is just...
Cool. I was like about to say, what was the 4th here? Like
buying within 20 k's of a CBD or a major regional marketplace city centre historically has performed a lot better than not, according to Michael Matusik.
What makes sense to me, even just from like the research I've done and a bunch looking into it, not to get into the why these make sense, but one being population. It's like, we know that population's a major driver just because it controls supply and demand in a property market. So if we're sticking to those major cities, you're just banking on the likelihood that population growth and immigration is going to be stronger in those areas, which I love. And then to your fourth point, I like it because it's income. So it's like, from a finance point of view, I know that borrowing capacities are limited by how much you can earn, and if you're close to that regional centre or where people work, just the potential of them having jobs, full-time jobs where they're paying well, which then leads to them to be able to borrow. 100%.
Like, the Australian Bureau of Statistics have released reports with the Australian government saying that 75% of Australia's income, population and job growth is going to occur in Sydney, Melbourne and Southeast Queensland in the next 25 years.
There you go.
You know, again, just roll with the 75%.
Yeah.
Don't, you know, I think Perth's going to get 8% or 10%, so that's 85%. The rest of Australia's going to get 15%.
Yeah.
Just play the averages, play what's worked and play what's going to work.
Yeah. I know where I'd rather be, that's for sure.
Yeah, and I see what it costs people. Like, there's a really interesting article that was produced by CoreLogic recently that looked at 20 years in Australia. And they looked at the 7 biggest capital cities versus 7 biggest regional. In the capital cities, the average increase in prices in terms of data was over 85% higher.
Oh, wow.
In those 7 capital cities versus buying in a regional market. So that's just... Imagine leaving 85% on the table on $1 million property. That's $850,000 that you've cost yourself by buying regional over buying metro.
That's huge, like huge numbers.
Huge money that no one is going to walk past on the street earning 100k per year.
Yeah.
Yeah.
And so I guess that's kind of, we've hit your foremost important, I guess, of the technical aspect of finding that right property, or thinking about it from that technical research side of things. From there, so you've got these ideas, you want to focus on the capital cities or the regional centres, or you want to be within 20 kilometres of them. So you've got a few ideas out there. How do you turn that into a set strategy though from there?
So it's really simple. You buy those capital cities or regional markets, you just buy houses and you buy as close to the city as you can afford.
Yeah.
So that's all people really need to walk away with the whole last 10 minutes we've talked about. Just do that.
Sorry to interrupt. If we go back to the first point of timing, I guess, is that what helped you define which of those markets you want to... So say we've got capital cities, we know you've just said 4 capital cities that could be of interest. How do you time which city to go for at what time?
It's a really good point. That Heron Todd White report is a great starting point.
Yeah.
And then reading Phil Anderson's book is another great starting point. But it's very, very clear as of 2018 when we're recording this that Sydney and Melbourne have grown by 50 to 85% in 5 years.
Yep.
So the timing is, according to Heron Todd White, at the top of the market or start of decline.
Yep.
And history shows us that could last for between 1 year and 3 years before it flattens out or stabilises and becomes affordable again for people. But if you look at Brisbane, for example, right now, Brisbane is at the start of the recovery, rising market phase, which is the perfect time to start thinking about buying. So, you know, in an ideal world, you'd look at buying Sydney and Melbourne after a GFC event and hold it for the first 5 to 7 years.
Yep.
And then you'd slide out of those markets which have topped out and recovered first, and you'd start looking at somewhere like Brisbane or a Perth or a South Australia, or one of the major regional markets around those cities that, have the best run according to the history in the second half of the cycle. And you can see that really clearly in the CoreLogic data if you look at it.
Yeah, and with the recent cycle we've seen since the GFC, you can almost see that happening exactly at the moment. Who's to tell what's going to happen next, but banking on that data, we're assuming that trend's going to continue, and we know where that next, the next hotspot's going to be, if you want to call it a hotspot.
Yeah, I mean, I hate hotspotting personally just because it seems like chasing quick money.
Okay.
And the quicker you chase money in property, the quicker you lose it.
Yeah.
But I think if your underlying strategy is Sydney, Melbourne, Brisbane makes sense now. Brisbane might make sense for the next 5 to 7 years, and then Sydney and Melbourne might start looking really good again.
Yep, I love that. Like just what you said there about, investing, not just speculating sort of thing. We're not trying to, this is the hot market, let's jump in and out over a year and try and make a bulk of money. We're not speculating, we're trying to invest over the long term.
100%.
Yeah.
So, sliding into property investment goals from those 4 things, like if I was to sit down with you or anybody else, these are the questions I'd ask to help you decide or define your property strategy. So would you consider yourself a low risk or a high risk investor?
I'd like to say low risk, but I do tend to go at high risk at times. So I would say I'm probably sitting pretty in the middle of that one, if that's okay.
Yeah.
Sorry to be a bit ambiguous.
Like, you're not one or the other. There's all sorts of, like, 50 Shades of Grey in the middle.
Yeah.
Adzi likes that sort of thing. And he's got all sorts of shades of grey in him.
Yeah, and my hair, for one.
So are you looking for low risk or... Sorry, I've just done that. I was just looking into your hair. No, sorry.
So high risk, so you know the tell of the grey.
Short term or long term?
No, let's go high risk.
High risk?
Yeah, high risk with long term gains.
Okay, cool. And are you more interested in units or houses?
Houses, from what you've just told me before.
Regional or metro markets?
Typically I liked regional, to be blatantly honest.
Yeah.
But obviously, like a lot of the research and what we've gone through working together, I see the benefit of metro, but let's say regional for the case study's sake.
And regional to us means Sunny Coast, Gold Coast, Newcastle, Wollongong, like quality large regional markets that will be over 1 million people within 20 years.
Yeah.
Or 30 years, not, you know, regional as in 10,000 people towns.
Yeah, and no mining towns, thanks. I know, like, high risk, but not that much.
What about existing property versus brand new?
I'd prefer established property. Yeah.
Okay, cool.
Or existing property.
And what about small land size versus larger?
I'd prefer larger land size as well, yeah.
And unrenovated or completely renovated property?
I'd say unrenovated at the moment, just because like we don't have children at the moment, me and my partner, and so we are pretty hands-on and got a lot of time to kind of invest into our property at the moment.
Okay, cool. And then single income, which means just a home with one tenant, or dual income, which might be like a house and a granny flat?
Oh, a house and granny flat sounds pretty great, like having that dual income potential. I don't know if I would be in a financial position to move on that straight away, but it definitely sounds interesting.
So like a house with granny flat potential that you could realise when you want to cash flow down the line? Exactly,
yep.
Alright, cool. And then are you looking to purchase one property for the rest of your life, or are you looking to purchase multiple properties over the course of your life?
I'm going to say multiple, I think.
Cool.
I can't imagine myself stopping with just one.
Sure. You're fired if you do. No, I'm just kidding. I just don't want you to be earning 50 grand in 50 years time.
Yeah. I don't want you to be earning that in 50 either. I'm glad you're looking out for me here. Let's go have a chat.
And then the last question is low depreciation versus high depreciation.
I'm going to be blatantly honest. I say like I'm into finance and stuff. I'm not an accountant though. I'm thinking low depreciation. I don't see the benefits for me personally at the moment for high depreciation. That might change in the future, but yeah, right now it's just, I can't see it as a priority.
Cool. So, you know, anybody listening to this could ask themselves the exact series of questions, overlaying those 4 little things we talked about a moment ago. So let's just, you know, like go back to that. We've got a strategy, let's say for example, that you've sit down and you've done that and you've gone, cool. In terms of the market, I'm going to buy Brisbane. Yep. I'm going to buy within 20 k's of the city of Brisbane. I've got a $450,000 budget. Yep. Because we know we can buy great houses within 20 k's of the city. Yep. And I'm only going to target houses. So, you know, timing wise, it makes sense for Brisbane. We're going to buy houses close to the city on big pieces of land. Yep. Within 20 k's. So that's how we've ticked the boxes strategically. Yep. Then we're going to look for a low risk property, which means buying in a suburb with a high income.
High risk, sorry.
High risk, oh shit. Okay, so you're high risk. I'm extremely low risk, so, you know, we just wouldn't work together. Effectively, like, that's the reality. Like, yeah. I used to think I was high risk, and maybe doing what I've done would be classified as high risk, but, you know, I don't know how you could be high risk unless you really started to over leverage to the hill right now. Yeah. Or go out and start developing, which, you know,
maybe I have made that swing to low risk now, and I just like to tell myself I'm still high risk, because to be honest, that's why I was a bit umming and ahhing about the question, because I do definitely like associate myself with high risk, but I don't do too many high risk things anymore.
You know, high risk is for some people just buying a property. Because we work in it, because you and I have helped clients buy over 300 million bucks worth of property, buying a property to you isn't risk anymore, but to a lot of the people that you and I are mates with, it would be ridiculously high risk and very scary.
Yeah.
So, you know, to the average punter, we could be classified as that, but to what we know, it might be very low.
Yeah. Agreed.
So, you know, we've got this low risk strategy, which if you're following the fundamentals of buying Brisbane, timing, buying a house and buying within 20Ks, that is a low risk long-term strategy because history has shown us that that's going to outperform basically everything else.
Yeah. You're making it sound really simple. I'm sure there's a little bit more that goes into it though.
Not that much more. Like, people overcomplicate buying for their first time, as you know.
Yeah.
It is actually really simple. What's difficult is having the discipline once you've got your strategy to just follow it.
Yeah.
So when something shiny comes up over here...
Oh, what, I can pick up that property for $100,000 cheaper? Surely there's no reason why.
You know, and then it's on a main road or next to a cemetery or it's in a flood zone or it's in a bushfire zone. You know, there's a reason it's cheap.
One thing I've learned is there's always a reason it's cheap.
Always a reason.
Yeah.
Unless we're in a GFC and everything's cheap, there's something really wrong with the property to a smart investor if it's 50 grand below everything else around it online.
Yeah.
So, you know, I used to chase the quick money, the get rich quick money when I was 24 and doing this, 25, 26, 27. And I've just realised that all of that short-term thinking cost me a huge amount in long-term gains. And now I won't do that anymore because...
Is that in like the transactional expenses of going in and out of property, do you think so? Or
more, you know, buying on a cheaper pocket of the suburb, on a busier street as opposed to buying a quieter pocket with a really high quality property.
Yeah.
You know, smaller land size thinking that wouldn't change things.
Yeah.
Or smaller property thinking that wouldn't change things, as opposed to just going straight out for quality.
Yeah.
Anyone listening to this would know this right now. You know, you just think about the suburb that you live in, own in or rent in. You've got good pockets, you've got middle pockets, you've got cheap pockets, you've got good streets that are really quiet, that everyone around there mows their lawns and wants to live there, and you've got really not nice pockets. And I don't care if you're in a $5 million suburb or a 200K one, everyone should know what I'm talking about there.
Yeah, I know about it for my area.
Yeah, and if you think about that area 10 years ago, that cheap pocket and the expensive pocket when property prices were 400 grand might have only been a 50K difference from the busiest road to the best street.
Yeah.
Now that the properties are worth $1 million, the good stuff's worth $1 million and the cheap stuff's worth $650. And over time, that gap stretches massively.
So that gap actually it doesn't stay the same, like relatively wise, it actually even gets bigger.
It compounds ridiculously.
Okay, awesome. That's great to know.
Yeah, so, you know, that's, you know, an example of Adzy's strategy in practice. So it means going out and buying an existing property on a big block that you can clean up with some potential to build a granny flat. And if that's your strategy and you've got those 10 things written down on paper, then it's much, much easier now to start looking at suburbs within Brisbane or areas within Brisbane that tick those boxes, and then properties on realestate.com that actually tick those boxes.
Yep. So as far as that process goes, we've talked a bit about that strategy, which kind of linked into identifying a market, like where do we want to go, which we've done. Now, if we're actually going to that, so we've got an idea, we know what we want, we've got a strategy, we know where we're looking, how do we actually make that happen? Sorry, that took me a little bit to get out.
Sure.
But how? I guess is the word now. Like, we know we can get it, we know it's there. It's like, me personally, I'm thinking like, how much should I be paying for this property if I find one I like? Is there like, then once I do it, I'm a little bit like scared, thinking maybe I'm paying too much, maybe I'm paying too little, maybe I've got a steal here. And I've listened to our video and I'm starting to get scared, being like, what's actually wrong with this property that I haven't figured out yet?
Yeah, I mean, there's a few things there. Like, in terms of the how, there's the relationships with the agents, there's setting up the alerts, and there's inspecting the properties, and that's kind of one basket.
Yeah.
And then there's a second thing there, which is the how, and that is, before you even do any of that stuff, what is market value? You know, you know, I've found Brisbane. I like North Brisbane because of the numbers. I like this particular suburb in North Brisbane. You know, now what does market value really look like? And
yeah, I don't know. Like I can see the median price. I can find that information pretty easily. But like you said, how do you define which are the pockets? And then you got to try and figure out, from there, where that, like, because obviously you got a benchmark of value where value sits, but you don't know if you're in that higher quality sort of property which you managed to find and you're getting it at median price, or if you've got that crappier quality, or sorry, that poorer quality property that you're overpaying for it around that median price. So is that, like, I'm just thinking median price, is that too simple?
Median price is dangerous because the suburb that I own in right now, the median price last year went up by 35%.
Yeah.
This year the median price has come down by 42%.
Yeah, wow.
If I was to look at medians, I would be like feast and famine. Like, you know, medians can be heavily skewed by outliers, as you know.
Yeah.
Either side of the equation. So if a heap of cheap properties sell, the median comes down and it looks like the suburb's losing value.
Yeah.
If less sales are at the top, or if more sales are at the top, it can heavily skew the median that way as well.
Yeah.
And we're finding this in Sydney right now and Melbourne, where some properties in some suburbs, blue chip suburbs, have dropped by 10-15% already. It's just because no one's selling the $5 million properties anymore that are pulling the median up and making it look really cool. And what's happening is some people are exiting the market out at the bottom side of things and pulling it down. It might not necessarily mean that the average property is dropped at all. It just is the skew.
Okay, so that is quite of a dangerous way to look at it then.
You know, a better way that I look at it is I jump on the sold section of realestate.com and I put in 3 and 4 bedroom houses in my criteria, and on properties with at least a 500 square metre piece of land. And then I just start documenting, you know, the sales. I start looking at them, I click into it, you know, what value do I get there for that price?
Yeah.
What I like to do, because I'm a bit OCD, is print out a map of the suburb, and then I start putting dot points across the map of, you know, the sales prices, and I filter them into 3 little categories. You know, red being cheap, orange being middle, green being high.
Yep.
And then I just start dotting them, and after you've dotted 30 or 40 house price sales across the suburb, you'll start to see the pattern of where the cheap stuff is, the expensive, and the middle stuff. And you know, then as I start looking at properties that are online for sale, I start having that little map in front of me and going, cool, like this looks like good value because it's an affordable property in the best pocket of the suburb. Then I click through to the property and go, you know, why is it so affordable? You know what I mean? It might be a really small floor plan, it might be an odd shaped block, it might be on a slightly busier road. But you can start to figure out those things.
So that sounds like you've done a little bit of research, and then obviously, like you mentioned, alerts earlier. So like setting up those alerts would help to facilitate that process. You also mentioned relationships with agents, and hearing all that, it seemed like that is quite a major part of it, because obviously if you have those relationships, and from what we see is properties don't last long on market at the moment, so obviously
in the right suburbs, at the right price. And
so obviously those relationships can be quite important at getting those properties brought to you and helping you understand what the potential pitfalls of that property might be. So obviously an agent trying to sell to you, working on their seller's best behalf, is going to be less likely to let you know of any issues with that property. So I can see that kind of being a problem for a lot of people that don't have those relationships, or are trying to figure out exactly why this property is priced the way it is. Yeah,
like, you know, you'll go out and inspect 10 properties tomorrow, and as a result of the relationships that we have, you know, the next week 4 out of the 10 properties, or 40%, will be completely off market just as a result of those relationships over time. And so that's 40% of properties that the average punter like me or you, when we were starting out, never saw. And as you know, like, they're the quality properties that would sell in the first weekend in those markets that never come to market because people don't have an opportunity to. Or maybe they come to the market on the first day, but we've seen it 2 weeks ago, and so, you know, the offer is accepted on day 1 where before the first weekend. So those relationships with agents aren't impossible to build, but they are tricky. You just jump on OpenAgent or ratemyagent.com.au. You type in the suburb that you're thinking of, and then it will come up with the 3 agents that have sold the most stuff. They're the only 3 worth talking to from a relationship perspective, because they're selling 80% of the stuff. And so it's just about going, you know, I'm looking actively in this suburb, I've got a pre-approval in place, I'm ready to buy. And here's my strategy. Like, if you've got your 1-page strategy in front of you, which we talked about, you email them that strategy. This is exactly what I'm looking to spend. This is the pocket. This is what I'm looking to do. And then you just call them every single week until they find you something.
Yeah.
And they will find you
Sweet
something,
email.
you know what I mean? They want an easy sale as much as you want an off-market property.
Yeah, I guess that's the importance of identifying those high-performing agents as well, because they know the value of an easy sort of sale, and that it can still be at a point where the seller and buyer are both happy. Doesn't have to mean that it's something like, just sorry to divulge a little bit there. It's just diverge. Sorry. It's some agents you'll notice are they get a bit caught up in their own process and a bit attached to certain things, and they're not open to these new ideas. So like, say a buyer coming to them and telling them exactly what they want, find me this. Some agents might be intimidated by that, whereas those better agents will just know exactly how to use that information and get a good outcome.
Yeah, because you've got to remember, with every good agent, they've got 5 or 10 properties for sale at any point in time, and 5 or 10 people that they're about to convert for the next month.
Yeah.
And so they've always got these properties that are coming up that they know, and sometimes all they need to get the listing is, hey, I've got this buyer from Sydney or Melbourne or Perth or Brisbane that really wants this. They're ready to go right now. Here's their pre-approval.
Yeah.
Let's get this on, and everyone's got to win for someone to win. You know, you can't just be the person picking the eyes out of the marketplace all the time.
Yeah.
Sometimes buying a high quality property at market value and ticking the strategic boxes is so much better than buying a property 20-30 grand below and missing half of those boxes, which costs you a couple of % of gains per annum for the next 15 years.
Yeah, I can see how that's important as well. Like, it's easy to, I guess, make sacrifices on your strategy or goal to say, oh, but I'm getting it this much cheaper. Oh, I'm getting it $20,000 cheaper, and all it is on a main road. That's fine. Like, it's not even that main of a road, and it might change in the future, or you come up with this story inside yourself to tell you why it's going to be okay.
And if you knew market value, this happens all the time. We're just like, I can't believe someone paid that for that. But they saw it was 50 grand below online, when it was actually 50 grand above what it should have been selling for on that road. They just didn't do their due diligence.
Yeah, I actually seen one 2 weeks ago, and it was across the road from a school, and like one house back from a main road, but it was, went for probably about $50,000 over what we were expecting it to go for.
It happens.
Yeah, like, you don't feel like, we liked the property. It wasn't a terrible property, but do you really just want to spend $50,000 when there was a few questionable aspects to that property? But sorry, I won't diverge too much again.
I love that, man, because I think that's the reality of being a first-time buyer. I thought I was getting a sick deal on my first home. I realised that I bought, it was a unit in Sydney. I realised that I bought the worst unit complex on a busy road, opposite a park, you know, with all of these maintenance related issues. I think I didn't check the body corporate property properly, and it went from 2 grand a year to 12 grand a year within 2 years of owning it. Like,
there's no sinking fund in there.
There's no sinking fund, and it was just an old building, and people were exiting en masse because they knew what was coming that we didn't.
Yeah.
So there's all sorts of things as a first timer. You're never going to get it 100% right. Like, you look at our checklist, things we do before, during an inspection and after, there's probably 200 things that we apply, which are lessons that I've learned, you've learned, where we've really stuffed it up.
Yeah.
And that has become a process. But as a first timer, you've just got to tick the big boxes if you're doing it on your own, and know that it's not going to be the perfect decision. There's no such thing as a perfect property, no matter how much you've bought.
Yeah.
But if it ticks 95% of the boxes that are going to be meaningful to you in 15 years once you know more, then that's all you can do.
And I feel like we've touched on a few of those big rocks earlier with those 4 items that you talked about.
It's just those 4 things. You just do that.
Yeah, so it's the old, put the big rocks in the jar first, and then you can try and go from there, but just don't forget that you do need to take action on it as well.
Yeah, without a doubt.
Cool. So we've talked a little bit about building a relationship with agents, setting up alerts on realestate.com domain, those sort of websites to help you kind of, I guess, get your initial sort of flow of properties in your pipeline to kind of go through and look at.
Yeah.
Then from there, so you've got to go out and actually inspect the property. What would you want to, like, I know there's so much to go through with this sort of thing, and some of it's really the building investor's responsibility, or other factors, or someone else involved to do this, but is there a few things that you think are really important that people should look out for in their first inspections of properties?
It's a really good point. It's not so much the physical property. Like, you just want a property with a nice big backyard on a good block in a quiet street with a nice big open floor plan.
Yeah.
Good sized bedrooms, kitchen, bathrooms, dining, etc. Like the stuff that you and I or anyone listening to this would want to live in.
Yeah.
You know what I mean? That's what you buy. You buy something that you would want to live in. Maybe right now it looks like crap because it needs a cosmetic reno.
Yeah.
But cleaned up, it looks like the sort of place that you could see yourself in. And I believe a lot of people don't talk about this, but there is an emotional side to investing which is really important, which is, does this tick my gut? You know what I mean? Like, do intuitively, you know, Cronulla Beach, where I grew up, looked like absolute hell 30 years ago. 20 years ago, it was such a shithole that when I was going down there surfing, I couldn't leave my bag on the beach without getting it stolen. You know what I mean?
Yeah.
Cronulla Beach now is a $3 million suburb with up to $10 million sales. You know what I mean? Like, you've got to be able to see past where it is and what it could be. And that's not just the property level, but that's the suburb level too.
Okay.
Because a lot of these places in Brisbane, you've just got to think Brisbane's 15 years behind Sydney and probably 10 years behind Melbourne.
Yeah.
And so Melbourne, Sydney 10 years ago looked very different to how they look now. And that's Brisbane too. Like, there's a lot of renovations occurring. There's a lot of knockdown rebuilds. There's a lot of change and development and infrastructure going in. And over time that will wash through the market.
Yeah.
And 19 k's from the city in Brisbane might feel like a bit away right now. But think about being 19 k's in the right suburb from Sydney or Melbourne. You're absolutely knocking it out of the park now.
Yeah. So like, I guess with that, you talked a little bit about just seeing past what the initial sort of, I guess, your first impression, or like reading a book by its cover. And
I don't like the carpet, I don't like the yard.
Yeah, so look a little bit past, just be like, okay, does it have good bones? Oh yeah, it's got some hardwood flooring underneath. It's the whole thing's made out of hardwood, or it might be a brick base underneath, or those sort of little things that you can go, oh okay, it's quite stably, or like a really good construction. All I need to do is make some cosmetic improvements, like you mentioned, some paint, change the flooring, maybe polish some floorboards.
Simple stuff, you know, 10-15 grand worth of work to get it looking $1 million.
Yeah.
But I think that's a really good thing that we've just jumped to. So you've got your strategy in place, you've identified your market, you've identified your suburb, then you get straight to property. But there's a missing middle there that I think is the secret within a suburb to buying great and beating the suburb average performance, which is possible.
Yeah.
So if this suburb goes up on average by 5% a year, there's properties that go up on average by 6 and properties that go up on average by 3.
Yeah.
You want to be on the 6 category, which is buying the right pocket, but then it's more what you don't buy. Like, you don't buy on main roads. You don't buy on roads if you can afford to, where buses run. You don't buy directly behind rail or commercial or industrial or next to any of that stuff. You don't buy opposite parks or public swimming centres or, you know, schools or universities.
See, parks surprises me a little bit. Like, what's the thoughts behind not buying across from a park?
It just affects the long-term capital growth of properties next to the park. Like, people want to be within walking distance to a park. But parks can be dangerous. Parks can have unexpected things in them.
Yeah.
Parks can attract youth where they, you know, party on weekends. Parks can be annoying as hell. Like, if there's soccer, netball, you know what I mean, whistles going off all day, Saturday, Sunday, all week for training. It's kind of not desirable to the best houses in the best suburbs in Australia and not directly opposite parks. They might be one street behind it and a walk to it.
Cool.
So I'm thinking about what the best looks like, and then reverse engineering that backwards to what I want to buy, because you should be aiming for the best. Why would you sacrifice anything if you don't have to? Yeah,
no, that makes perfect sense. So from that, I guess a lot of it can really be done from home, that research, just identifying it. You obviously need to drive out and about and get out in the suburb and get a feel for the place and identify those sort of things.
The last 5 properties I've bought, man, I didn't even see.
Yeah.
Because I knew that much about the suburb before I even started to look. I didn't inspect a single other property in the suburb.
Yeah.
I just knew, you know what I mean? And I'm not saying every first time is going to be able to go to that level. And it helps when you guys are going out and checking out stuff every week for me, and vice versa for yourself. But it should be at that level. You should know that much about the suburb that it is just a no-brainer for you to buy that property when you see it, because you know that it is special.
Yeah.
And if it doesn't trigger any red flags around it's too cheap or it's on the wrong street, then sometimes these little gems come up, and that's what we try to buy as a business.
Yeah, of course. So we haven't touched too much about actually when you're at the property. I guess that side of things is looking past the initial and just seeing what it could look like and what potential is in that property, and just making sure you get all those other things right. Like you said, no main roads, the bigger block sizes, bigger backyards.
I think we should do like a full video on inspecting, because it's too much to cover now properly, and I don't want people to miss the 20% that really matters by skimming past it. Yeah,
100% agree. Awesome. Well, so at this point we've found a property. I guess from there you got to submit an offer, and how, like, to me, that's one of the scary parts, is where do you start? Like, where's that first offer coming in at? Like, do you try and lowball? Do you try and like start at close to the price? Do you go over what they're asking because you really love this property and you feel like you've been looking for years when really you've only been looking for 2 weeks? The rest of it was just dreaming.
You know, for a lot of first timers it feels like years by the time you listen to all the stuff. So it's a really good question. Like, we've got a negotiation strategy which in a semi-warm market works, or a cold market works very well. In a really hot market there's no rules. If the right property comes up at the right price, you just get in. Think about Sydney, Melbourne 2016. People know what I'm talking about there, or Perth 7-8 years ago. You know, Brisbane 12 years ago. But our negotiation strategy is really simple. We start with an offer about 10% below the market or below the listing price online, knowing that we're not going to get it. Like, just to put this in perspective, guys, you can lowball the hell out of people for your whole life. You're not going to buy anything of value, because the marketplace sees the value. If you're buying at the right time and all those other things, buying at the right time in Sydney, like an example of this is if you had have bought 7 or 8 years ago in Sydney or Melbourne, you would have doubled your money by now. You could have spent 2 years or 3 years out of the market, like some people did, lowballing and trying to get value, but you cost yourself about 30 to 40% over that time and hundreds of K of value. So buying the right property at the right time is so much more important than lowballing. But coming back to negotiating, sorry, that was a full rant.
No, it makes sense. Like, you're just highlighting the point. It depends on the market conditions. Like, obviously, if we're seeing that the average days on market's 30 days and a settlement takes 30 days, they're basically getting sold the day they're listed. You can't come in with a 10% below market offer and expect the agent to even get back to you. They'll probably just start talking to the next guy who's probably already submitted that offer on market, like at that listing price.
Again, the last 5 properties I bought were all market value, but I bought the right suburb at the right time and have made about 15 to 20% in 2 years on everything I've bought, because I bought the right thing at the right time.
I think an important thing too is market value doesn't sound that attractive, but it, like, look through the sold properties and see how many are sold overpriced. Like, there is a lot. So, like, getting market value is still a good point as long as you're getting that right property, like you said.
In a hot market,
tick all the boxes.
Some person directly after you is going to come and pay more. And you know, I had my own home recently paid, because my wife didn't let me negotiate the way that we do. She came in and put all our cards on the table and told them that we wanted to move in that day. And I had no leverage, so we ended up paying 100 grand more than what it was worth. The cool thing is it was at the right time for that suburb to start increasing in value. We set a new sales record in the street, and then all of a sudden people followed, and you know, now we've probably made 100K in 9 months on that property because people are paying 200 grand above where we were. So, you know, again, I knew that the timing was right for that suburb as well. And, you know, 100 grand lesson as well, the hard way. Doesn't feel great. But our negotiation strategy is very simple. There's 3 parts. The first part is starting with an offer 10% below with really bad terms.
Okay, so by bad terms you mean long finance and long building finance, and long settlements. You
know, 45-day settlement, 50-day settlement, 28 days finance, 20 days building and pest. And an agent goes, this is horrible, but they have to legally present it. Then they obviously push back and go no. And then if they just reduce their asking price by $1, like if they come back $1 below what it is online for, you know they're open to negotiating. If they come back flat out and go no, you can offend a lot of people doing this as well. and a lot of agents too, which is where your relationship comes into play. And you know, you come back with a second offer which is, you know, let's call it 5 to 7% below the realestate.com price. with really good terms, your best terms, you know, 30-day settlement, 14-day, 21-day finance, 10-day due diligence, 10-day building and pest. And then, you know, you're still playing the game here. And then if they've conceded $1 first time round, the second time round they'll have come down and you'll be somewhere in the middle now. Then the third thing that you do, because again, I don't expect that to be accepted in a good marketplace when you want to be buying. The third thing you do is your best offer, which is your best terms, which you've already presented, and your best price. The second offer is very close to where you want to buy it for. The third offer is just exactly what you'll pay. Maybe you leave $1,000 or $2,000 up your sleeve. And then at this point you say you've got 24 hours to make this decision, because it's already taken a couple of days to get to this point, or we've found something else. And you play the game, and the agent will generally, if they're a good one, come back and say, you know, you're close, they just want an extra couple of K, and you're like, no, if you think you can get away with it, or, you know, what's $1,000 on $1 million property type thing.
Exactly. So you come in basically, this is my best and final, and tell them that, but just knowing that you've got a little bit up your sleeve just in case for whatever comes up.
It makes the agent's job a lot easier and gets you a win. Then as soon as you get your building and pest inspection back, you can renegotiate a discount based on some of those issues anyway. Sometimes. It
obviously depends on what sort of property you're buying, because if you're buying like a low maintenance brick and tile home and it's not too old, you're obviously going to find a bit harder to pick those building and pest items apart, because there won't be too many. Yeah,
you know, I've used this strategy personally probably 7 times, and to buy over 500 properties for our clients. It is highly effective. And even the agents that we buy 10 properties off a year don't see the pattern with the way we negotiate, because it's always coming in different, it's a different property, but that strategy is highly effective to get a discount. And it can be really, really, really powerful way of making it feel like a win-win for everyone.
Yeah, and we're trying to, obviously the agent's working the seller's best behalf, but like Ben said, it does make the job easier for the agent, because it takes that ambiguity out of it. They know that this is your best and final. He can go to the seller and go, this is the offer we've got at the moment, and then the seller can make an informed choice that this is all they're getting, and it's not like, oh no, push back a little bit more and push back, and then go finish in a back and forth position where no one gets to where they want to be, where there could have probably been a deal on the table.
100%. And you know, I have no problem paying market value at the right time. Don't get caught up in $1,000 here or there. It doesn't matter over 15 years. Because if you've bought the right property in the right suburb, you know, history, if it's Sydney, Melbourne or Brisbane, suggests that it will do significantly better than this. But even if it only does 4.8% a year growth for 15 years, if you've paid 400K, 15 years from now, it's now 800 grand. You know, just, you've got to think about the big picture, and that's why having your long-term strategy in place really helps with removing yourself from the little things that first timers get caught up on.
So like say if you're sitting there thinking, I'd pay $390 for this, 400's too much, and then you walk away from that deal and it's a great asset, a great property, that's, you've saved yourself $10,000 potentially on trying to negotiate that, but in the long run you're missing out on what? Like if you never make that move, you could miss out on $400,000.
You see people all the time. Like I talk to lots of people that are 30 that don't get started till they're 45. I speak to heaps of people at 45 who started to think about it that don't get started till they're 60. You know, imagine buying a $400,000 property in Sydney 15 years ago. It's now worth, we know it's worth a lot more than 800K. It's now worth about 1.2, so you've tripled your money. Think about being another 15 years from today. As much as Sydney feels expensive today, it isn't. Long term, it's absolutely dirt cheap. My grandma, who bought on the northern beaches at the very top of the hill at Dee-Why, thought that paying $4,000 for a brand new home was expensive when she bought it as well. Mum and Dad thought it was expensive when they bought 20 years ago in the Shire for $100,000, and then thought it was very expensive when they paid 300K for a property. You know, that property is now worth 1.5 mil. It's just a long game. Stop worrying about the month to month, stop worrying about the year to years, stop focusing on the little saving here and there and the niggly stuff that people get caught up on, and just remember the bigger picture, which everyone gets to. It's just, oh shit, I'm now on the pension, the bigger picture's in place now. You know, it would have been good to start investing, or you know, my friends or my family's done this, I missed out on it. you know, now what? You know what I mean? Like, it's 5 years down the track. I miss Sydney, I miss Melbourne.
Yeah.
I've cost myself from indecision 500k minimum. Now what? You know what I mean?
Wait for the 18-year cycle to come back around and go again.
And what, miss doubling your money in Brisbane over the next 15 years? You know what I mean?
Then be too scared to go in next time round because a GFC's just happened, or like until the recession we had to have just happened.
There's always a reason to not do stuff as a first timer.
Yeah.
And I suppose why we've tried to be as detailed as we can about things in this podcast is, yes, there's a few moving parts, but the more information you have, the better decision you can make. And I just want people listening to this to be able to go out there and make a better decision than I did.
Yeah.
And, you know, leverage off that good decision into a great decision. That's what I want.
Just compound it, like we've kind of touched on as well. Like that first property, try and do as well as you possibly can. But obviously, as we've touched on, action's a large part of making this whole thing work. So come up with that strategy, start taking step forwards to where you need to be, and yeah, like just get in there and actually do something about it and stop listening to us. No, just joking.
Yeah, stop listening to us.
How's that for a bit of advertising?
So you've submitted your offer. Your offer's now accepted.
Yeah.
There's a few things that we need to do first time round which feel overwhelming, but they really aren't. You get your building and pest inspection. You do your due diligence, which your solicitor helps you do. They're just the searches on the property to make sure it's all good.
Yeah.
You review your report, which is going to scare the absolute crap out of you first time round unless you're a builder, because it's 70 to 80 pages of protecting themselves and about 2 to 3 pages of what's actually going on with the property.
Yeah.
Again, we'll talk about in future episodes how to use that building and pest inspection report to get stuff sorted on the property or get a discount. I've done videos of that on our YouTube channel, just Pumped on Property over there, which you can check out too. And then you've got your finance as well. So, you know, the big thing everyone needs to know about the offer being accepted is there's heaps of paperwork. You probably can expect 30 pages from your solicitor, 30 to 60 pages from your finance broker. You know, you can expect 60 pages plus from your building and pest as well. Like, there's a lot of stuff going on there. I like to just, instead of reading it all, like I obviously read it all, but I like to just pick up the phone first and go, if this was you, give it to me straight. Yeah. And find out what's really going on first, so you know what you need to read, what you need to action, and how it's going to impact you. Okay, so basically you get it done, your say building and pest inspection done, that comes back to you, and then your response is always, can you break this down into layman's terms or into a way that... I'm not a builder, I don't know what I'm looking at, can you help me figure it out? Yeah, and then they'll be able to help you identify what are the parts that are important and say what's worth perhaps trying to negotiate on or readdressing. There's one great question, one great question to ask, and that is, if this was your money, would you buy this property based on this report? Yeah, that is a great question. And the guy's going to tell you straight, because everyone wants to help everyone out. Yeah. So that's what I ask, like, would you buy it? And what are the major issues that I need to fix now? What are the issues that are going to come up in the next 5 to 10 years? Yep. What's your one great question for mortgage brokers? I don't have one, it's just get me the money. I think that is an important part about finance though as well, because there's so many different levels of it, and a lot, like working in the field, I learned that a lot of people wanted to be educated about it, but it is constantly changing, it's always moving. That education doesn't quite mean as much as what you think it does. You're probably better off figuring out, like we've said, identifying goals, your property investment strategy, telling your broker exactly what you want to do, and just go, is this something that I can do? Is this something that you can help me do? And if not, what can I do to make it happen? Like, see, I personally go and get a pre-approval before I even start looking, so I know what I can borrow. So that's right up the top at the research phase for me. Yeah. So that going into a property, because going into a property when you know you can buy it gives you leverage, because a lot of people don't know if they can borrow the money yet, and agents are so scared of that. 1 in 3 sales in Australia falls over with finance, and it's been like that for 10 years. So an agent's nightmare is someone that doesn't know if they can borrow money yet or not. If you come in going, I can borrow and here's proof, then it really sets you up for a good sale price and a quicker offer. Yeah, and when you're building that relationship with the agent at the start, that's obviously a point that helps as well. So this is what I'm looking for, here's my pre-approval. They know what you're approved finance-wise, up to what budget, they know what to work with, they've got all your goals, they can help facilitate that process a lot easier.
So I guess we haven't gone into a lot of detail about your building and pest reports or that sort of negotiations or offers or inspecting properties, but I feel like we've given you a really good overview of what goes through that process. So we've gotten to a point where that's all happened. We've got finance approved for the property. We were happy with the building and pest report, and we were happy to go unconditional on that contract.
Yep.
That all went through. Then we lead up to settlement. We made that happen just by doing what our solicitors and our finance brokers or our bank manager, whoever it is, told us what we need to do through those steps. Then we move through to we've owned the property. What now? Like it's always a bit of a, oh, we've just put so much work, so much effort, we've invested so much emotionally and time-wise that it's kind of a little bit like, now what?
Now what? For me, it's simple. There's just two things, you know, and this is probably in the week leading up to settlement, you start organising all this.
Cool.
The first is, you know, using my building and pest report, are there any issues that I need to fix before someone moves in?
Mm-hmm.
Or in your particular case with your strategy, it's unrenovated. What do I need to do to actually get it to the condition that I want to rent it out in? So am I doing the carpet, polishing the floor, painting, changing the window finishings, changing the lights, adding fans, for example?
Yep.
So I organise what needs to be done / is there anything I'd like to do?
Mm-hmm.
A lot of people that we work with just don't want to do anything, so it's a low maintenance property ready to chuck a tenant in for 5 years and forget about it.
Yeah.
But you identify what you need to do, and then you work in with your property manager to create, or let them create a marketing strategy around, you know, this is how we're going to market it, this is how long it's going to take roughly, this is how we should price it, get it online as early as you can, so that you can start finding that right tenant as quickly as you can and reduce your vacancy rate.
So sorry to jump into a little bit of the nitty gritty, but if I was looking to do those renovations, do I do that immediately before a tenant goes in? Is that the timing for that?
It's a really good question. I personally have two reasons why I renovate. One is because I have to, because I've bought an absolute pig of a property and I need to clean it up a little bit.
Yeah.
And personally, I just do the absolute bare minimum for that. Actually, there's three reasons. That's the first one. The second one is because I want to add value to the property to release equity, to make some money, so I do that. The third is if I'm selling the property. Outside of that, I really keep my properties in a good maintenance condition, but, you know, a normal state. And I don't spend money unless I can make money back. Yeah,
that makes sense. Like I agree with that as well. The whole saving for any of your major renovations or major upgrades for before you're selling the property, and when you can actually, turn it into some cash in the short term instead of dumping all that in and then feeling a little bit frustrated, like you want that return from your rent, which from what we've seen, it typically doesn't lead to a much higher rental return for dumping that money into the property.
A lot of first-time investors, myself included, because I renovated the first 3 properties I bought as soon as I bought them.
You looked happy about that.
Like I'm so happy that I've now learnt my lesson and lost money.
Yeah.
You know, we all go through this stuff. If you go out there and make your property something that you want to live in, that's fine. But you've probably used half a deposit for another property doing that.
Yeah.
So there's only a few things that the tenants really value, and that is a well-maintained property with heating, cooling, fans, you know, blinds, paint, you know, just simple cosmetic stuff. It's effectively lipstick for your property.
The wall's not falling down, you know, there's actually paint on the walls. There's
a clean, fully fenced yard, you know what I mean? Like, I've rented properties with mould. You know, like,
same.
There's all sorts of things going on, and there's always someone at your stage of life, but I've learnt the hard way that a good tenant is worth its weight in gold.
Yeah.
And I would prefer to have a property that is well maintained, that looks okay, that I haven't lost money by doing that on it. You know, and then I'm very strategic about when I renovate, because I know as a first timer, my dollars are best spent buying more property to build the foundation that will make me financially free, rather than getting caught up in, I want every property that I own to look like something that I'd want to live in, because I'm emotionally tied to it.
So I guess that draws back around to the start a little bit, and we go a little bit full circle there, where it comes to, we've talked a lot about that 12-month strategy and in that sort of phase, but it has to link back to a long-term strategy, and obviously your long-term strategy is collect assets, so you save doing those renovations to the right point in time to allow you to keep collecting assets.
100%, and you know, that's enabled my wife and I to be in a much better position because we've collected good assets earlier, that will, 5-10 years from now enable us to be where we want to be.
Yeah, and you can always put that money into the properties later on in time when they need that renovation, or say you might just feel like you want to do it at that point in time.
For sure, well, there's a reason to do it, you know what I mean?
Yeah.
So, I know we've talked about a huge amount. We've talked about, like, at the very start of this, the research being so much fun, which I believe it is. Like, I was just so inspired when I read Rich Dad Poor Dad, because I'm like, shit, like, the dots are now connected. I know how I'm going to carve my path in the future. And I felt the same way when I read Phil Anderson's book, The Secret Life of Real Estate and Banking. I was like, someone has actually looked at history, not just read what's happening in the media this week.
Yeah.
And history has a funny way of repeating itself. Like, you can learn about the future from the past.
Yeah, and it's obviously not just property that's the case. You can hear that story across the board in a lot of different, I guess, expertise or areas. So
you and I were at Tony Robbins together recently, and they talked about success leaving clues. You know what I mean? Like, you don't have to carve your own path.
Sounds so cool. Success leaving clues.
Find people that are where you want to be and just copy what they do until you're there.
Yeah.
And I've done that 3 times now with mentors that I've had in the last 10 years. And, I've achieved or exceeded where they were at this stage in their life because I learnt quickly and applied quickly.
Yeah.
Identifying your goals, where you want to be in 12 months, where you want to be long term, acknowledging and accepting you've got challenges, and it's not always going to be rosy, and it will be a bit stressful.
Yeah.
That's fine.
And putting together that team of advisors or those people around you, like you said, you've had 3 different mentors that have really helped you along the way, and it doesn't necessarily have to be mentors, it can be peers, it can be anyone that is in a position that can help you. Don't be afraid to ask, don't be afraid to put your hand up and say, give us a hand, or can you help walk me through this, or whatever it is.
100%. And then there's the property investment goals, where we talked about the 4 things: timing, buying the capital city markets, houses, and buying close to the city. And then there's the little things underneath that we talked about with Adam around low risk, high risk, etc. Then you use that to define which market you're going to buy, which suburb, which type of property.
Yeah.
You go out there and you submit your offer's accepted, you go through the settlement process, and then you get the thing rented out and cleaned up. So buying is so exciting, so much fun. Like, it's literally changed my life in such a good way, and I know you guys have just build an awesome home as well. Like, it's just a fun thing to do.
Yeah, like my personal, I guess, attitude to life is it's just a game. Like, obviously these things, like, there's certain things you have to take very seriously and do properly, but more so I look at it in the way that you just got to be in it. Like, you got to be playing that game, like, not playing it in that sort of sense, but just, get involved, give it a try. Like, you only get one chance at life, so don't let it pass you by. Not to get too emotional, but yeah, that's just my thoughts on it. So it's like, if you're umming and ahhing about making that wrong choice or making that mistake, there's usually a workaround. In worst case scenario, it's going to cost you money. It's probably going to be less than the opportunity cost you missing out by not moving forward. So I just think get involved.
Yeah, and there's so many things you can learn. I'm a very analytical person, and when it comes to investing, like, I'm very, very detail orientated personally. It's just how I am. But it's because I've cost myself so much in the past, with stuff that I've done, and I'll share more of that stuff in future episodes about massive mistakes that I've made that you guys can learn from too.
Do you regret any of those mistakes?
Nah, man, because I'm a way better investor now because of it.
Exactly. So it's just like a learning lesson, really. So yeah. Just try and keep it as cheap as possible of a learning lesson.
We'll talk about that in the future. There's some fun ones. Cheers for your attention and time, guys. It was great to catch up. Feel free to jump on our YouTube channel and subscribe there. If you like what we're doing in the podcast, please leave a review. The next episode's going to be heaps of fun as well. We're going to talk about how you can actually go out there and make $50,000 a year of passive income by investing in property. So appreciate your time and good luck with everything you're trying to do.
Thanks, guys. Enjoy.